Class, hope you can hear me.
Yes.
Yes.
Okay, good evening. Yeah. So this night we will round up taxation of specialized business by God's grace. We will round up taxation of specialized business so that by next week we talk about tax implication of merger and acquisition by next week. So far on taxation of specialized business, we have talked about airline, shipping and telecommunication company. We have discussed bank and we have solved question. So this night we have the first area we are going to look at is taxation of real estate investment company. Taxation of real estate investment company. Real estate investment company, the abbreviation is REIC. So how we tax this company? Who are the real estate investment company? They are the company engaged in selling of building, leasing of building, selling of land. You understand? So they are into investments that relate to anything on land and building. Sometimes they may build and sell. Sometimes they may build and rent. Sometimes they may be the one own, they may have a land and they will be selling. The example of such a real estate investment company like Adron Homes and Properties. They are the examples of a real estate investment company. So how do we tax such a company? So how do we tax them? First and foremost, we need to look at the nature of business of a real estate investment company. For a real estate investment company, income generating from properties of land and building is where they generate their income. What are their nature of business? Their nature of business range from acquisition of land, development, holding of portfolio of real estate assets. So they acquire, they develop, they hold portfolio of real estate assets. That is the nature of business. So their primary income is coming from real estate assets. Their primary income is coming from real estate assets. So what are the sources of income of a real estate investment company? What are the sources of income of a real estate investment company? Number one sources of income of a real estate investment company is rental income. Sometimes they may build and they will be renting the building. Rental income. Number two, dividends. Dividends from another real estate investment company. They may have shares or invest in another real estate investment company. At the end of the day, they will be giving them dividend. Another one is gain. Gain from disposal of assets. This one means gain from disposal of land or disposal of building. We know if a company that is not involved in selling and buying of land is not their primary business, a company that is not involved in selling and buying of land as their primary business, if they dispose an asset, if they make a gain, such gain will be subjected to capital gain tax. But in the case of real estate investment company, if a real estate make a gain from disposal of land or disposal of building, it will not be subjected to capital gain tax. Rather, it will be subjected to company income tax because it is their primary business. Because it is their primary business. So it will be subjected to company income tax. So one of the sources of income of a real estate investment company is gains from disposal of assets. Another sources of income, other income. Other income can come from interest on fixed deposit, bonus, or investment in another company. All these are other income, or estate agency fee, commission. Sometimes real estate investment company, they may help a property owner to rent their building. They will collect a commission or agency fee. All these are what? Other income. Now, taxation of income of a real estate investment company. How do we tax income of a real estate investment company? How will we tax income of a real estate investment company? We have to look at Section 19 of CETA. Section 19 of CETA. Section what? 19 of CETA first. Section 19. So, for Section 19 of CETA, out of this income of a real estate investment company we mentioned 4 income of a real estate investment company. We mentioned 4. Rental income and dividend income, according to Section 19 of CETA, they are exempted from tax. Rental income and dividend income are exempted from tax according to Section 19 of Company Income Tax Act. However, for a rental income and dividend income to be exempted from tax, Section 19 of CETA give out some conditions. One of the conditions is at least 75% of such rental income or dividend income must be distributed to the shareholder of the real estate investment company. At least 75% of such rental income or dividend income must be redistributed to the shareholder of the real estate investment company. Second condition is such distribution must be made within 12 months after the end of the financial year. Second condition is such distribution must be made within what? 12 months after the end of the financial year. So that is what Section 19 of Company Income Tax Act said about a real estate investment company. It said income of a real estate investment company, which is dividend income and rental income, will be exempted from tax, provided that minimum of 75% of such income is distributed to the shareholder of a real estate investment company. And such distribution should be made within 12 months after the end of the year. Now, let's look at Section 23 of CETA. Section 23 of CETA is saying that related expenses any expenses that is related to dividend income and rental income. If rental income and dividend income have been exempted from tax, any expenses relating to them, such expenses should not be allowed as an allowable expenses. That is section 24. Section 24 of CETA is saying that related expenses that is related to dividend income or rental income, if rental income has been exempted from tax or dividend income has been exempted from tax, the expenses relating to them too should not be allowed as an allowable expenses. The expenses will automatically be treated as a disallowable expenses because their income has been exempted from tax. Their expenses relating to them too should not be allowed for tax purpose. That is what section 24 of CETA is talking about. It's saying about taxation of a real estate investment company. Section 80 of CETA is saying that if such rental income or dividend income has been subjected to withholding tax, the withholding tax on such rental income or dividend income that is exempted from tax, such withholding tax too cannot be used to reduce our tax liability. The withholding tax relating to rental income or dividend income that has been exempted from tax, such withholding tax too cannot be used as a tax deduction. Such withholding tax, we can't use it to reduce our tax liability. So that is what section 80 is talking about. Now, let's look at illustration. Let's look at illustration. Mark Incorporated Limited is a real estate investment company that operates under a real estate investment scheme. The company received a rental income of 500 million during its financial year, August 2022. Within 12 months and was elected as the buyer. Taxable rental income for the relevant assessment and commit appropriately. That is A. B. On the tax implication, commit on the tax implication and effects, assuming the management of Incorporated Property Limited decided to distribute 85% and retain the balance. First is this real estate investment company. They receive a rental income of 500 million. The question first said 60% of the rental income was the one that is distributed to the shareholder within the 12 months. If you want to look at the A part of the question, is the rental income subjected to tax or exempted from tax? Is it subjected to tax?
Subjected to tax.
It is subjected to tax because it is 60% that was distributed to the shareholder. What is the minimum distributed rate?
75%.
75%. So let's look at the scenario A. Mark Incorporated Limited, computation of assessable income for 2023 year of assessment. The accounting year end is 2022. The year of assessment will be 2023, preceding year basis. This is the rental income received, 500,000. Distribution to the shareholder, they distribute 60% to the shareholder, which is 300 million. 500 million is the rental income. 300 million is the 60% that was distributed to the shareholder. Required distribution. What is the minimum distribution that they're supposed to distribute? At least 75%, which is what? 375 million. Since the actual distribution is less than the required distribution, the rental income will be subjected to tax. We will have accessible rental income. We will have what? Accessible rental income of 500. All the 500,000 will be accessible to tax. All the 500 million will be accessible to tax. So we are asked to comment. A real estate investment company shall not exempt from tax on a rental income or dividend income if it does not distribute a minimum of what? 75% of rental or dividend to the shareholder. And such distribution is not made within what? 12 months. In this scenario, the distribution was made within the 12 months. Out of the two conditions, it passed one. It was made within the 12 months, it passed. But since it is 60 instead of 75, it failed. That is the reason why we subject all the 500,000 to tax. Now, let's look at scenario B. Comment on the tax implication or an effect, assuming the management of Mark Incorporated Limited decided to distribute 85% and retain the balance. So what is the tax implication? B part. We will recompute the tax liability, the accessible income, sorry. Mark Incorporated Limited, computation of accessible income for 2023. They say we should assume it is 85% that was in distribute. Distribution to the shareholder, 85%, which is 425 million. Required distribution, 75%, which is 375 million. Since the actual distribution is more than the required distribution, by virtue of that, all the 500,000, this rental income of 500,000, all of them will be exempted. All of them will be exempted. It is not that 85%, it is everything that will be exempted. Everything. Since it is more than 75%, everything It is not the actual percentage. So the amount exempted will be 500 million. Our accessible rental income will be nil. There will not be rental income that will be subjected to tax. Hope this is clear. The only condition where this rental income will not be exempted if it is more than 75% is it is when such distribution is not made within 12 months. It is made more than 12 months. If the distribution is made after 12 months, in that case, the 500,000 will be accessible to tax, even if it is more than 75%. But in this scenario, they said the distribution was made within the 12 months. It is okay. And this case, it is 85%, which is more than the required distribution. So everything will be exempted from tax. So that is it on this scenario. Let's look at scenario 2. Scenario 2. Mark here in limited Security State Commission to carry out and operate a real estate investment scheme in Sokoto, Nigeria Limited. Make up its account to 31st of July. Below is the extract from the annual return for 2023 year of assessment. Rental income, dividend income, gains from disposal of assets, management fees received, profit on other related business, allowable expenses, additional information. The distribution to the shareholder was made 30th September 2022 as stated below. Look at what was distributed to the shareholder out of the rental income. 650 million 125. For dividend income, 75 million 135 naira 150. That is what was distributed. B part of this question. Profit from related business comprises of turnover from sales of property. They sell property. This is the turnover. Expenses, sales agent commission, brokerage commission, security fee, advertisement fee, other property expenses, profit from other related business. C, capital allowance. Required, compute the income tax liability and tertiary education tax for what? For 2023 year of assessment. Comment on the tax implication of the company transaction as related to real estate investment company in accordance to CETA. So this is a full question on a real estate investment company. When we are giving a question on a real estate investment income. How do we solve the income must be stated first. This one, what are the incomes? The income from this. Sorry, as this the network is very bad. I have to change to my other line. I'm very sorry for the interruption. It was the network, MTN network. So I have to use Glo. So now, like I said, rental income is one of the income. Dividend income is one of the income. Gain from disposal of assets is one of the income. Management fees, one of the income. Profit from other related entity, other related business. If you have breakdown, look at it. We were giving the breakdown. So his income is turnover, which is 500,000. We will report the income when we are solving this question. Income has to come first. After the income, we can now less all the relevant expenses. However, these two income, rental income and dividend income, they have some condition. If they distribute at least 75% of that rental income or dividend income to the shareholder, they will be exempted from tax. And if the distribution was made within 12 months, look at the end of the accounting year end of this company. The accounting year end is 31st of July. They say the year of assessment is 2023. It means the accounting year end will be 31st of July 2022. 31st of July what? 2022. When was the distribution of rental income and dividend income was made to the shareholder of this real estate investment company? It was made September, 30th September 2022. The question I want to ask, does such distribution made within 12 months?
Yes,
the accounting year?
Yes.
Eh?
Yes, sir.
Yes, sir.
Yes, it was made within 12 months. Now, let's go and test. Let's go and look at the percentage of the distribution that they make, whether it's more than 75% or it's less than 75%, so that we are going to know whether we are going to exempt them from tax or subject them to tax. Let's go and check one by one. Let's go to the solution. Solution. MacBook Investment Limited. Computation of company income tax and education tax for 2023 what? Year of assessment. Rental income received. How much is the rental income received? 750 million 150. Now, how much was distributed to the shareholder out of the rental income? We are told 650 million. 650 million 125 was distributed to the shareholder. Let's look at the percentage. Is it up to 75% or less than 75%? 650 million 125 divided by 750 million 150. We are going to get 87%. Since it is 87%, it means the actual distribution is more than the required distribution. The required distribution is 75%. So is it going to be exempted from tax or subjected from tax?
Going to be exempted.
How much will be exempted?
Right, drop it.
All.
all the rental income,
All will be
all the rental income, all this 750 million 150. So that is it on rental income. You can see we put exempted. Where we put this exempted, we can put the actual amount of this 750 million 150. We can put it in brackets so that we know that we exempt it. Now let's go to dividend. Look at dividend. Actual distribution of dividend was 75 million 135 150. The total dividend earned by the company is 150 million 250. Let's look at the percentage of the distribution made. When we divide it, it is 50% that was distributed. The actual distribution is 50%, while the required distribution is what? 75%. Is it going to be exempted or subjected?
It will be subjected. Subjected.
It will be subjected. Since the actual distribution is 50%, it's less than 75%. Do you understand? That means 150 million 250 naira will be subjected to tax from dividend income. Aside that, the first income that will be subjected to tax is dividend income. Other income that we have in this question is this breakdown of profit from other related entity. This is the breakdown. Turnover, the now less expenses, they get the profit of other related entity. What we need, we want to take, when we are solving question on real estate, you report income first. So we will take the income. Income of this other related entities, turnover from sales of property, which is 500 million. We will take it. Turnover from sales of property is income. We take it. So our first income is dividend income. Our second income is turnover from sales of property. Another income given to us in this question is what? Management fee received. Management what? Fees received. Anything fees, professional fee, consultancy fee, legal fee, management fee. What is it going to attract? What type of tax such fee is going to attract at source?
Withholding tax.
Withholding tax. Management fee, professional fee, director fee. They will attract withholding tax. Withholding tax is an advance payment of income tax. It's a tax deducted from income at source. It's one of the anti-tax evasion policy used by government. Example, if you render a professional, you are a professional accountant, you now render a professional service to one of your clients. You charge your client 200,000 naira as professional fee. The law says if your client want to pay you, your client cannot pay you the 200,000 naira. If we deduct what? Withholding tax. It depends on the rates. It can be 5%, it can be 10%, it can be 15%. But with regard to professional fee, it's 5%. But withholding tax on management fee is 10%. Look at this. They say management fee received. Is it the gross amount that was received or the net?
Net.
Is the net. Because assuming the right management fee, we can assume is gross. But they say management fee received. This is actual what we receive. Is the net that the income earner will receive. It means they have deducted withholding tax from it. When we are computing tax liability of the person that receives such income, we will report the gross, not the net. So let's look at this management fee. The net is 125,234,450. For us to get the gross amount, we know that withholding tax on management fees is 10%. 10 minus 100, we get 90. So for us to get the 100%, this 125,234,450 is 90%. For us to get the 100%, we are going to say 100 divided by 90 times this amount. We are going to get the 100%. The 100% of this management fee is 139,149,389. Gains from disposal of assets is another income given to us. So in a nutshell, we will add all the income together that is subjected to tax. We will get total income. We will get what? Total income. What is our total income? Our total income is 864,274,889. After the total income, we can now say less allowable expenses. The only expenses we are going to less from this total income is allowable expenses. Let's now go to the expenses. Which expenses is allowed? Let's go and look from the beginning. What are the expenses we have? What are the first expenses that we have in this question? We have allowable expenses of what? 247,875. We are going to less it. If we look at it, allowable expenses, you can see the 247,875 is part of the expenses. What other expenses do we have? We have other expenses that relate to turnover on sales of property. This turnover on sales of property, it has some other expenses. It has expenses that relate to them. Sales agent commission, the pay sales agent commission is an expense, it's allowed. We less it. Brokerage is allowed. We less it. Security is allowed. We less it. Advertisement is allowed. We less it. Other property expenses is allowed. So we less all those expenses. We less them. We less them. Assuming we have disallowable expenses, we not use them all. It's only allowable expenses that we less so. And again, another thing that they can give us allowable expenses relating to rental income. They can say rental income expenses or expenses relating to rental income. Are we going to less it or we are not going to less it?
If the rental
we will not less it.
In this scenario, the rental income is exempted from tax.
Yes.
Its expenses, are we going to less it or we will not less it?
We will not less it.
we will not less it because the income has been exempted from tax. Do you understand? So that is another scenario. Question can be set. At the end of the day, when you minus your total expenses from your income, you are going to get assessable profit or adjusted profit of 343,845,989. After your assessable profit or adjusted profit, what do you remove from your assessable profit or adjusted profit for the profit to be taxed? What are you going to remove? When you have adjusted profit, for you to convert it to total profit that will be taxed, what are you going to remove from your adjusted profit?
That's the allowances.
Capital what?
Allowances, yeah.
Capital allowance. Do we have capital allowance in this question? Yes, we have 250. What? 50 million. So our capital allowance is what? Look at or adjusted profit, 343,845,989. Our capital is 250 million. You have heard of restriction of capital allowance. You have started capital allowance computation. My colleague will take you capital allowance computation. So in capital allowance, when you want to claim capital allowance, there is a law that says you cannot claim all your capital allowance. You have to restrict to what? 2 adjusted profit and profit. So that you can have enough total profit. The assessable profit that we have in this question is 343,845,989. 2/3 of it is going to give us 229,230,659. Since it's less than the actual capital allowance, our capital allowance that we are going to claim for that year will be 2/3. Why the balance will be what? Carry forward. Out of the capital allowance of 250 million, only 229 will be less from the profit, will be removed from the profit. The balance will be carried forward. I want to ask a question. Assuming the 2/3 of this adjusted profit or assessable profit is more than the actual capital allowance, is more than this 250 million, which capital allowance are we going to remove?
The 250.
The 250. We will not remove the 2/3. Since the 2/3 is more than the actual, we remove the actual of the 250. Do you understand?
Sir, please, I have a question.
Okay.
But it's when you were speaking about withholding tax, could you please shed more light on the difference between VAT and withholding tax? There are some companies that say they are VAT exempted, they deduct withholding, they deduct VAT.
Some companies are what?
They say they are VAT exempted, that they don't pay VAT. So when they make payments, I work in an automobile company. When they make payments, they deduct VAT, they deduct withholding.
Okay, point of correction, madam. They are
Okay,
not.
sir.
They are not saying they are VAT exempted, that they don't pay VAT, but they are agent of VAT collection. Some companies, they have power to deduct VAT at source. They will deduct VAT direct from their invoice. You know, when you sell goods to somebody or you render service to
Yes.
another company,
Yes.
you are the one that will charge VAT. You that
Yes.
render the service, Abi?
Yes, sir.
The company, they are the one that's supposed to pay you the VAT. Why they
Yes.
deduct withholding tax, Abi?
Yes, sir.
But FRS give some company veto power. They call them VAT, direct VAT agents. FRS say that anytime they render service to such company or they sell good to some company, instead of the seller of the good to deduct VAT that is charged, it is the company that will deduct it from the invoice and go and remit it to the FRS. Example of such company, MTN,
Okay.
all these oil and gas company, Shell, Mobi, government ministry. If you sell good to government ministry now, a ministry, you sell good to them, you charge them VAT. Assuming you charge them 200,000 VAT, they will not pay you that VAT. According to the law, FRS is saying such ministries should deduct the VAT from their invoice and go and remit it in your own name. You, the seller, they will remit it in your name. So some big organizations like bank too, they are direct VAT agents. At a time, FRA published the list of direct VAT agents. Dangote is among them. Most of the commercial bank, all the commercial bank, they are direct VAT agents. Why they introduce direct VAT agents is they discover that some people, they will charge VAT on their invoice when they sell good or when they render service. After charging VAT, after receiving that amount, they will not go and remit the VAT to the government. Government now empower some organization and some agency of government that anytime that somebody charge you VAT, instead of you paying the VAT to the seller or the service provider, go and remit it direct to us. You have a power. Hope your question is answered.
Yes, sir.
Okay.
Thank
So,
you.
yeah. So, this is how we get the capital allowance. Restriction of capital allowance is only applicable to trading and servicing company. It does not applicable to manufacturing company. It does not applicable to agricultural company. We can only restrict if such company is a service company or trading company. But if the company, they are into production of goods, we cannot restrict. We will claim all the capital allowance. If the company is an agricultural company, we cannot restrict. We will claim all the capital allowance. Hope you understand. When you less your capital allowance from your accessible profit, you are going to get a total profit of 114,615,330. And you compute your company income tax. Your company income tax rate, looking at the turnover of this company, look at their turnover. Their turnover is almost 864 million. It's more than 100 million. So your company income tax rate will be 30%. 30% of total profit. 30% of 114,615,330. You will get a company income tax of how much? 34,384,599. You will now ask yourself, does this company has withholding tax? Does any of this company income subjected to withholding tax that has been deducted as source? If yes, you will less such withholding tax. You know, management fee, the gross amount of the management fee is 139,149,389. But when they want to pay this company, they pay them net 125,234,450. Which means they have deducted withholding tax. The difference between the net and the gross is that withholding tax that has been deducted, which is 10% of 139 million. We will less it from the company income tax. It will reduce the company income tax because they have already paid this withholding tax to government already. They have paid it to the FRS already. It will reduce their company income tax. So the net tax payable after the net company income tax payable after withholding tax is going to be 20,469,660. 20,469,660. Education tax. Education tax is based on your assessable profit or adjusted profit. It's going to be 3% of your assessable profit or adjusted profit, which is 3% of 343,845,989. You get your education tax. I use 3% for education tax. Which of the year of assessment? Why did I use 3%? It's 2023 year of assessment, and I used 3%. Mind you, last week when I was solving one question, I said you will start using 3% as for what? 2024 year of assessment. Why do I use 3% here? I use 3% here because of what? Financial 2023 that introduced 3%. Starts effective, it commenced on 1st of September 2023. It commenced when? 1st of September 2023. Financial 2023. The date of commencement of Financial 2023. Because it was signed into law. And the commencement date is 1st of September 2023. Looking at this company, the accounting year end is 30th of July 2023. Thirtieth of July 2022. 30th of July 2022. If the company want to file a return, what is the due date for filing return for this company that the accounting year end is 30th of July 2022. If they want to file company income tax return, what is the due date? What is the due date for filing company income tax return?
6 months after.
6 months after, Abi, after the end of the year. You
Yes,
are correct. In the case of this company, what is 6 months after the end of this 30th of July 2022? What is the 6 months?
December, January.
December. I think it's
30th
January.
of July 2022.
December.
January 2023.
It's January 2023, yeah.
January 2023. So as per the rates, I will look at the rates why we use the 3%. There's a scenario I want to create here, but that one will not delay us. In an exam, they will give you when to use 3%, when to use 2.5%. But the reason why I use 3% here, there was a scenario I created, which I'm still going to look at. Understand? In an exam, at the back of your exam question, they will give you when to use 3%, when to use 2.5%. So that is it on question
I
of
have
a
a question,
real estate.
sir.
Okay, what is your question?
Yeah, on the restricted amount, 2/3 of accessible profits,
Yes.
you restricted the capital allowance to 229 million. Accessible
Yes.
profit is 343 million.
Yes.
Okay, I was trying to look at the condition for restricting the capital allowance. I just seek further clarification. I was thinking is if the capital allowance will be greater than the accessible profit and there will be no profit left. Well, I don't know why it's being restricted here since the accessible. Get my question, sir.
I get your question, my brother. You are thinking that the only time we can restrict,
Okay.
assuming this capital allowance, which is 250, is more than 343. Abi? That is when we can restrict.
Yes,
That is what you are asking. That is what you are asking about, Abi. But it is not necessarily. Anytime 2/3 of your accessible profit is less than the actual capital allowance, you restrict. Anytime 2/3 of this your accessible profit or adjusted profit is less than your actual capital allowance, you restrict. It is not only when your capital allowance is more than your accessible profit. No. Do you understand my explanation? Do you understand? Do you understand my explanation? Anytime the 2/3 of your adjusted profit or accessible profit is less than your actual capital allowance, you must restrict. Hope I've answered your question. Huh?
Yes, sir. Yes, sir.
Okay, okay. So any other question? Any other question? Any other question? In the absence of no question, can we move to the insurance, taxation of insurance? In the absence of no question, we can move to taxation of insurance. Taxation of insurance business. How do we tax insurance business? Taxation of insurance. How do we tax insurance business? First and foremost, what you need to know under insurance, under taxation of insurance, is that there are two types of insurance business: life insurance business and non-life insurance business. For the purpose of tax, we group insurance business into two: life and what? Non-life.
Non-life.
Some company, when you want to compute tax liability for insurance company, if that insurance company, they do a composite insurance business. Composite simply means they engage in both life and non-life. You will compute tax liability of life separate, tax liability of non-life separate. You cannot add the operation of life and non-life together. They are different business segments, and we must compute their tax separate. Another thing we need to know on insurance company: what are the primary income of insurance company? Primary income of insurance company. Like bank, their primary income is interest. In insurance company, their primary income is what?
Premium.
Premium. Premium. For a life business, premium income is not taxable. Why for non-life, premium income is taxable? You have to know that point. For a life business, premium income is not part of their income that is subjected to tax for tax purpose. But for non-life, premium is part of taxable income. What are the major expenses of a bank? Cost of major expenses of a bank. Who can tell me? Of insurance company, their major expenses that will contribute significant percentage. What are the major expenses? Claims.
Yeah.
Claims. Claim pay to the policyholder. You know that I said for premium, for a life business, premium is not taxable income. Since premium is not taxable income for a life business, claim too is not allowable expenses. But for non-life, premium is taxable income. Claim is allowable expenses.
Sir, please, can you come again as regards the claim?
God. I said for a life business, claim is not an allowable expenses since premium is not taxable income. But for a non-life business, claim is an allowable expenses because premium is a taxable income. Do you understand?
Okay.
If insurance company receive dividend received by insurance company will be treated as what? Frank investment income. Aside from premium, insurance company may have investment income like dividend, rent, commission, management fee, interest on fixed deposit. All this investment income, they are taxable under both life and non-life. All the investment income of a bank is taxable under life. It's also taxable under non-life.
Excuse me, I'm just curious. Why is the premium for life not taxable? Then at the same time, the claims are therefore not allowed.
Why? Because
Yeah,
there's
I'm just
that premium for life business, assuming you are in the insurance company, you are working in an insurance industry, you understand that premium for a life business is not, they don't treat it as part of their income based on the insurance act. It's just like a third-party fund.
okay, because somebody will either die and they will pay
Yes,
it out, they will make, or they will pay out something. Yeah, even if you
yes,
don't die, there's something they provide in insurance where you can, at a particular time in your age, they can pay you a bulk sum in the
they
future
can
if
pay
you
you
don't
a
die,
bulk sum.
something like that. Okay.
Yes. So let's look at changes that Finance Act 2020 introduced to insurance business. What are the changes? Prior to Finance Act 2020, if insurance business make a loss, they make a loss. The loss can be carried forward for maximum of 5 years. But Finance Act 2020 now said, henceforth, insurance company can carry loss forward indefinitely, like other companies. You have done loss relief now. You have done loss relief, have you?
Yes.
For loss relief, can company carry loss forward maximum of 5 years or indefinitely? What does the law say?
It's indefinite except for current year loss relief. It's 5
Except for
years.
current year loss relief. Carry forward loss relief is indefinitely. But before 2020, they said it clearly that insurance company cannot carry loss forward more than 4 years or 5 years. But Finance Act 2020 one of the amendments made to insurance companies say, you insurance company too, you can now carry your loss forward indefinitely. Another amendment that Finance Act 2020 made is that investment income is it defined investment income as an income derived from investment of shareholder fund. Finance Act 2020 defined investment income of an insurance company as an income derived from investment of what? Shareholders fund. Finance Act 2020 also said the turnover of a life insurance business, the turnover of a life insurance business is called gross income. Why the turnover of a non-life insurance business is called gross premium? If you want to compute minimum tax for life insurance business, the minimum tax is going to be based on gross premium, gross income. Why minimum tax for non-life insurance business is going to be based on gross premium?
Okay, please, that second part, it said defines investment income as income derived from investment of shareholders fund. That is the income, the investment income. Okay. Not if the premium received is invested and they make money from that investment, it does not constitute investment income.
It does not constitute investment income. You are right. It does not constitute investment income. When you invest your retained profit, you invest it in the real estate, you generate rent. It's an investment income. You invest your retained profit in a fixed deposit, you generate interest. It's an investment income. Do you understand?
Can you just repeat that again, please? Thank you.
Investment income that they are referring to, interest on debentures, interest on fixed deposits, rent on properties.
Okay, that's fine. But it's just the shareholders fund that is throwing me off now. The shareholders fund, as if it's only equity they're investing. Meanwhile, they can get money from premium and also invest it.
The shareholders fund that they are referring to, they are not referring to that ordinary share capital alone. They are referring to that retained profit too.
Okay. That clarifies that one.
So, how do we compute minimum tax? For a life business, the minimum tax of a life business is based on gross income. The minimum tax of a non-life business is based on what? Gross premium. As you all know, we know the percent. What is the rate of minimum tax for a company? Minimum tax rate 0.5%. I mean, so if you want to compute minimum tax for a life business, 0.5% of gross income. If you want to compute minimum tax for a non-life insurance business, 0.5% of gross premium. Another amendment that Finance Act made to Finance Act 2020 made to insurance company is on the area of unexpired risk. Before, when you want to compute unexpired risk under insurance company, your unexpired risk will be the amount as at the end of the year. But Finance Act 2020 said, now your unexpired risk is going to be the difference between the amount we have as at end of the year and the amount we have as at beginning of the year. Prior to 2020, if you want to compute unexpired risk, your unexpired risk is just your balance of unexpired risk as at end of the accounting year that you are going to use as an expenses. But based on Finance Act 2020, unexpired risk is an expenses under non-life insurance business. Based on Finance Act 2020, unexpired risk now, if you want to get your unexpired risk that you would use as an expenses, the difference between what you have as at end of the year and what you have as at beginning of the year. How do we? Another amendment that Finance Act made is in the area of claims. Finance Act said your claim for non-life insurance business, their claim can be the actual amount of claim paid and the estimated claim that they propose that they will pay. The claim that they will use as an expenses can be both actual claim paid and estimated claim. Before, they normally restrict your claim to 25% of your premium. But Finance Act 2020 have removed that restriction. You can claim your full claim now as an expenses. You cannot restrict your claim to 25% of premium again.
Sorry, sir. Please, I have a question.
What is the question? What is the question?
Okay, the claim stuff. Is it about for life or non-life?
Claim only applicable to non-life. Claim is not an allowable expenses for life. Claim for non-life business. Let's look at the format for computation of tax liability of an insurance business. Let's look at the one of life business, life insurance business. Like I said, premium is not an income. It's not a taxable income for life insurance business. Let's look at how we compute tax liability of a life insurance business. If you want to compute tax liability of a life insurance business, you have investment income, and your investment income will comprises of the pension interest, interest on fixed deposits. Aside from your investment income, you have other income like fees, management fees, commission, rent income, all these other income. At the end of the day, you add your investment income plus your other income together, you will get what is called gross income. You get what is called gross income. Now, if you get your gross income, you will now less allowable expenses or relevant deduction. First allowable expenses or relevant deduction is provision for general reserve. Provision for general reserve is one of the expenses that is allowed under life business. How do we get your provision for general reserve? Your general reserve as at end of the year plus your life fund account as at end of the year. Two of them together, you add two of them. You compare it with your net liability on policy. If these two is lower than your net liability on policy, your general reserve provision will be the summation of these two. But if your net liability on policy is lower than the summation of these two, your general reserve will be net liability on policy. Second expenses that you remove, allowable expenses that you remove, is special reserve. Provision for special reserve is another expenses that is allowed. Your special reserve will be higher of 1% of your gross premium or 10% of your net profit. You know, premium is not taxable income under life business. But the only place that we use gross premium of life business is when we are computing special reserve. Is when we use the gross premium. That is the only place that we use the gross premium. 1% of the gross premium or 10% of net profits. Anyone that is higher, you take them. Another one that we have, other allowable expenses. What are the other allowable expenses? Rent, salary and wages, printing and stationery, repair and maintenance. All those expenses, we put them under other allowable expenses. So the three major expenses line that we have under life business, number one is general reserve, number two is special reserve, number three is other allowable expenses. You add the three expenses together, you come and remove it from your gross income, you will get your adjusted profit. If you get your adjusted profit, if you have any loss that you are carrying forward from the previous year, you can come and remove it from your adjusted profit. After you removing your loss, you can get your acceptable profit. After that, you can less your capital allowance to get your total profit. If you get your total profit, you can now compute your tax. You can compute your CIT, you can put your education tax. And at any time, when you are computing tax liability of insurance company, Finance Act 2020 say you must compute their minimum tax. You must compute their minimum tax and you compare the minimum tax. For life, either you are computing for life or non-life, you must compute the minimum tax. That was one of the changes that Finance Act 2020 bring to insurance companies. Anytime you want to compute the tax liability, you must compute the minimum tax too. After you compute the tax liability, you compute the 30% of CIT, 3% of education tax. You compare your 30% of CIT with your minimum tax. For live business, the minimum tax will be 0.5% of gross income.
Excuse me, if we scroll this template up a little bit, there's somewhere I saw net profits. So I'm just wondering, where does net profit fit into everything we have done? Because if we go up, we have gross profits, then we started making adjustments. So where
is
net
gross
profit? Up.
My friend, where is gross
okay,
profit?
so not profit, gross income.
Yeah.
Gross income. After the gross income, how do we now derive net profits? Except they just give it to us. How do we derive
They
net
will
profit?
give us net profit. My friend, my people, when they give you insurance company question, if they give you a question on life, sometimes in the expenses, you may not have provision for general reserve. If information on how you get your general reserve provision is not given to you in the question, you will not use it. If information on how you get your special reserve is not given to you in the question, you may not use it. Some question, they will not give us information about these two, how we get these two. They will just give us other allowable expenses. That is what we will use. Then if they give us information on how we get them, we can use them. Hope is clear. If they did not give us information relating to how we get our provision for general reserve, we don't need to use it. If they did not give us information on how we get our provision for special reserve, we don't need to use it. Hope this is clear. So, under the expenses, we have three major expenses: provision for general reserve, provision for special reserve, other allowable expenses. Other allowable expenses: salaries and wages, rent, printing and stationery. You understand? Those expenses in the normal tax computation. In some question, under special reserve, the examiner will just give us gross premium alone. They will not give us net profit. That means our special reserve will be 1% of gross premium. We don't need to pay since we don't have net profit. In some question, the examiner will not give us gross premium. They will just give us net profit. Our special reserve will be 10% of the net profit. We don't need to compare. We don't need to say, yeah. So, ladies and gentlemen, even I don't like certain insurance question because insurance question is, you understand where I'm going. Insurance question, if you don't open your eyes very well, if you don't open your eyes very well, if you don't try your eyes very well, it's somehow out of the stagnation of specialized business. The only one I fear most is insurance business, insurance company. But it's not hard once you know the formula. Once you stop, what you need to practice. The more you practice, like I said, what we have done so far, we have done capital gain tax, we have done most of all the topic we have done so far. Go and practice them. Go and solve questions on them. Explaining like this, you may understand, but you need to go and solve questions. Start solving questions. The only way you can know task is by solving questions. My colleague, he has done a basis period, he has done loss relief. Look for a question you can solve. You will know them. But with our explanation now, we are explaining, it's good. Based on this explanation, once you know it, try to practice on your own. You need practice on your own by solving questions. So insurance is not hard once you know the guideline. So this is this on life business. This is how we get the one of life business. How do we get non-life business? How do we compute as liability of a non-life business? Non-life business. Under non-life business, I told you premium is taxable. You can see the first income I write under non-life businesses, gross premium. Out of this gross premium, I will now less premium return on cancel policy. Some policy that the policy holder, before he expire, he say, I want to cancel, I'm no more doing. Part of his premium, we have to return some to him. So that premium return, we less it from your gross premium. You get net premium. Sometimes you insurance company, you are a smaller insurance company, you may insure your risk with a big insurance company. By insuring your risk with a big insurance company, you are going to pay reinsurance premium. That reinsurance premium that you pay, you also less it from your gross premium. You also less it for your what? Gross premium, so that you get your net premium. After you get your net premium, you can now get investment income. Non-life business too, they may have investment income, they may have interest, debentures. They also have other income, fees and commission, rent receipt. You add all of them together. Part of the income under non-life businesses, estimated claim for previous year. Estimated claim, actual claim. Actual claim means the claim you pay actually. Estimated claim means the claim that you project that you may pay. When you are doing your expenses, both actual and estimated, you have two of them together. You less it. Tax say is allowed. But estimated claim of 2021 account is going to serve as an income in 2022 account, because you have used it as an expenses in 2021 account. In 2022, since nobody is coming to claim that estimated claim, it will serve as an income. That is the reason why I write estimated claim for previous year. So estimated claim of 2021 account will serve as an income in 2022. It's an expenses in 2021. It will serve as an income in 2022. At the end of the day, you add all your income together, you will still get gross income. Mind you, if you want to compute your minimum tax should not be based on your gross income. It should be based on your gross premium. That is what the law says. After that, you can now less expenses. The first expenses that you are going to less is unexpired risk. Unexpired risk reserve. Unexpired risk reserve. According to Finance Act 2020, the difference between your unexpired risk as at end of the year and your unexpired risk as at beginning of the year is the unexpired risk for the year, is what you are going to use as an expenses. That is the first expenses. Claims too is an expenses. Both estimated claim and actual claim, you add the two of them together, is an expenses. Other liable expenses, salaries and wages, printing and stationery, rent, commission too is an expenses. When you add all your expenses, you remove it from your gross income that you get. At the end of the day, you are going to get your adjusted profit. If you get your adjusted profit, once you get your adjusted profit, you can less your capital allowance, you get your total profit, and you can now compute your tax. Mind you, your minimum tax for non-life business is 0.5% of gross premium. So let's look at illustration. Let's look at illustration. Illustration 6. Let's look at illustration 6 first. Below is an extract made from the financial statement and income of a premium insurance limited for the year ended 30th June 2021 and 2020, for the year ended 30th June 2020 and 2021. Net profit before claim and outgoing. Estimated claim and outgoing. Actual claim and outgoing. Required, compute the assessable profit for the relevant tax year. We have to compute the profit that will be assessed to tax for the relevant tax year. In this question, this one is a non-life business because they are talking of claims. It's a non-life business. It's not a life business. The only way that claim can be allowed is for non-life. Claim is not allowed under life. So net profit before the claim is this. You less your claim because claim is an expenses. You less your claim. Estimated claim, you less it. Estimated claim for the first year that you want to do, 2020, your net profit is 36 million. Your estimated claim is 12 million, you less it. Your actual claim is 7.5 million, you less it. That means your assessable profit is 16,500,000. That is the profit that will be subjected to tax based on the little information given to us. In this question, we don't need to follow the format because the information given to us is limited. It does not require format. In 2021, your net profit is 28 million. Mind you, estimated claim of previous year. How much is estimated claim of previous year? 12 million. It will serve as an income in 2021. Estimated claim of 2020 will serve as an income in 2021. You add this, and that less estimated claim of 2021 and you less actual claim of 2021, you get your assessable profit of 22,100,000. This is a simple question. This one does not require format. This one, they want to let us know that what this one is trying to tell us is that estimated claim of 2020 that we less as an expenses, when we reach 2021, it will become income. Because when you look at the format, based on the format, I said estimated claim of previous year is part of the income of insurance company, based on the format. Based on the format, estimated claim of previous year, based on the format.
For this, the estimated claim of the previous year, we're adding it, okay? That the way you explained it, one understands it. But for the deduction for the current year, we're picking the actual claims and outgoings and also doing estimated. Is it not double counting? Guys, if we look at this question we just tried now, please.
And this is estimated claim for 2021. This estimated claim of 2021, in 2022, it will become income of previous year.
But there's still actual claim in the same year at the same time, the same year.
Yes, there will be actual claim, there will be estimated claim.
Okay.
Both estimated
So
claim,
the estimated is like a
claim means
provision, while the
provision.
actual is the one that has crystallized.
Provision means the one we provide that we are going to pay. The one we have paid already is the actual.
Yeah. Okay.
Hope you understand.
Yeah, it's okay.
Now, let's look at the one that we need formats. The one that we are going to use formats to do. Question 8. A life Nigeria insurance company is a life insurance company. The company provides insurance cover for what? A life contract. Below is the extract of the financial statement for the year ended 31st December 2020. Actuarial surplus, investment income, fees income, other operating income, life fund account as at the end of the year, general reserve, gross premium written, profit before tax, management expenses, depreciation, commission paid, NIGDA levy paid, capital allowance claim, net liability on policy, administrative expenses. Required, compute the tax and levy payable for the relevant year of assessment. Take into consideration the relevant amendment to the tax law, ignore VAT, 15 mark. In this question, we are going to follow the format. This is a life business question, life insurance business question, life assurance business question. In the life assurance business question, what are the income of a life assurance business question? Part of the format I gave you, if you look at the format, actuarial surplus is part of their income. Investment income is part of their income. Fees is part of their income. Other operating income is part of their income. It is only gross premium that we will not add for life business. So if you look at my solution, investment income, other income. So I added all the income together. At the end of the day, I get a gross income of 1,537,748,280. Based on the format, and now say less liable expenses. Number one liable expenses I have is provision for general reserve. And according to the law, if I want to provide for general reserve, my general reserve as at end of the year plus life fund account. My general reserve as at end of the year plus life fund account. So my general reserve as at end of the year is 85,086,540. Life fund account is 590,940,00. I add the two of them together. I now compare it with, this one is not less. I made a mistake here. I compare it with net liability on policy. The lower between the two is what I'm going to take. So in this case, there is a mistake in this question. In this solution, there is a little mistake. Is the lower I'm going to take. If you look at it, the lower between the two, if we add these two together, net liability is lower. So my provision for general reserve will be the net liability, which is 600,740. But in my solution, I went to go and less it. It's not like that. I have to compare the sum of these two with net liability. Is the lower I'm going to take. I will correct this after the class. After that, special reserve. Special reserve says the higher of 1% of your gross premium. In this question, we are giving the gross premium of the life business. This is the gross premium. It's 1,659,216,440. Or 10% of net profit. Where is net profit in this question? Where is net profit in this question? Do we have net profit in this question? Do we have net profit?
No. Profit before
Yes.
tax.
Yes, we have.
Where is it?
Yes. Profit before what? Profit before tax is the net profit. So we have it. I compare which one is higher between the two. Higher. 1% of gross premium is this. It's giving us 16,592,164. Why 10% of gross premium is giving us 56,460,544? Which one is higher? 10% is higher. So my provision for general reserve will be 56,460,544. Other allowable expenses. What are the other allowable expenses I have in this question? What are the other allowable expenses? Management expenses is allowed. Depreciation, is it allowed? Is depreciation allowed?
No, sir.
No. Commission paid, is it allowed? You paid commission, it's allowed. It's not claim, it's commission. NIGDA levy is allowed. So you less your allowable expenses, other allowable expenses. Administrative expenses too is given. It's allowed. You less all the other allowable expenses. At the end of the day, when you less all the other allowable expenses, you will get adjusted profits, which I'm still going to correct because of the mistake in the general reserve. You less your capital allowance, you get your taxable profits. When you get your taxable profit, you can now compute your tax liability. Our tax liability, CIT, is going to be based on 30% because the gross income of this company is more than 100 million. is about 1 billion. So 30%. I will compare this 30% with minimum tax. What is the minimum tax? For life business, the minimum tax is going to be 0.5% of gross income. Since my CIT, my normal CIT is 290 million. My minimum tax is 7 million. It's lower than my normal CIT. It means the company will pay company income tax based on the actual, based on 30%. It's not going to be based on minimum tax. So that is the reason why I pick the actual tax. Education tax. As at which year of assessment? 2021 year of assessment. As at 2021 year of assessment, education tax is 2%. But in my solution, I use 3%, which I'm going to correct. In education tax, in your exam, they will give you at the back of your question that from so year, this is the rate you are going to use. Aside that, police development levy, 0.5% of adjusted profits. You get that. That is how you get tax liabilities for this company. This is a live business. This is a live business. Once you master the format, you know that there are 3 major allowable expenses: provision for general reserve, provision for special reserve, and other allowable expenses. And under live business, gross premium is not taxable. Other income can be taxable, either investment income or other income. That is what we need under life. So that is it on live question. For non-live question, let's look at non-live question so that we go. This one too is direct. Jupiter Insurance PLC is a Nigeria company which carry on a non-life insurance business. The following figure were extracted from the company financial statement for the year ended 31st December 2023. First, premium received, dividend net, premium return, premium paid on reinsurance, claim paid, claim recovered under reinsurance, profit on sale of assets, provision for unexpired risk as at beginning, provision for unexpired risk as at end, agency expenses, management expenses, capital allowance, balancing charge required. Compute the taxable profits, tax payable by the company for 2024 year of assessment. So for us to compute this is a non-life business. Premium is subjected to tax. Our gross premium in this question is 7 million naira. In this 7 million naira, we are going to less premium return. We are also going to less premium on reinsurance. We are going to less 2 of them. You can see I less premium return, I less premium on reinsurance. Dividend is an income, the right net. It means it has been subjected to withholding tax. But dividend is not taxable under insurance company. Dividend is not subjected to tax because it's a frank investment income. The only place that dividend is subjected to tax is under a real estate investment company, and it has a condition that it will be subjected to tax. But other company, either bank or manufacturing company or trade company, once they receive dividend, dividend is treated as a non-taxable income because it has been taxed in the hand of the payer. And that tax, the tax in the hand of the payer, that they collect in the hand of the payer, is regarded as final tax. That is the reason why we call dividend as a frank investment income. So in this question, if I were you, I will ignore dividend. But in my solution, I use dividend and now later remove it. I gross it back. It is the net. They have deducted withholding tax for me. If I want to gross it back, the withholding tax on dividend is 10%. If I want to gross it back, it means 100 all over 90 times 583,200. But if I were you, I would not even use it at all because it's a non-taxable income. But looking at my solution, I use it. And now later what? Remove it again. It does not have effects. But if I were you, I will not even use it. I will just write my premium, my gross premium, 7 million. I will now less my premium return, premium on reinsurance. I will less 2 of them from my gross premium of 7 million. So that I'm going to get my gross income. If I get my gross income, I will now less allowable expenses, which is called relevant deduction. Under non-life, the first allowable expenses that you are going to less is provision for unexpired risk. And provision for unexpired risk, look at the difference between what you have at the end and what you have at the beginning. What you have at the end must more than what you have at the beginning. If what you have at the beginning is more than what you have at the end, it means that provision for unexpired risk is an additional income. But if what you have at the end is more than what you have at the beginning, it means that provision for unexpired risk is an expenses. In this question, what I have at the beginning is more than what I have at the end. That is the reason why I add this provision for unexpired risk to the gross income. Aside that, I have claim. Look at the claim I have. Claims of 1,900,000. They now said I recover claim under reinsurance. Claim I recover under reinsurance is just as an income to me. I will less it from this claim I paid. I will less it from the claim I paid. So if you look at my solution, the claim paid is 1,900,000. Paid, I will less it from the claim I paid to the insured. If I less it, I will get 1,490,000. That is the first expenses I have in this question. Other expenses that I have agency expenses, management expenses. I will add 2 of them together. I will also bracket them. You can see my gross income, 6,500,000. My expire risk, instead of it to result into expenses, it result into income. I add it. I now come and less my claim 1,000,000. Less expenses now 2,000. I get accessible profit. In this question, I have a balancing charge. You know, in this question, I did not tell profit on sale of fixed asset. Is it taxable or
No.
non-taxable?
It's not taxable.
It's non-taxable. That is the reason why I did not use it. I did not use profit on sale of fixed asset at all, because it's not taxable income. In this question, I have balancing charge. When you have a balancing charge, what does balancing charge mean? When you get to capital allowance, balancing charge simply means when you sell a qualified capital expenditure, the sales proceed is more than the tax written down value. You add balancing charge, you less capital allowance. If you have balancing allowance, you also less it. But in this question, I have balancing charge. After my accessible profit, I will add the balancing charge. Look at what I'm getting. I will now less capital allowance. I will get my total profit. So I cannot complete my task. If I want to complete my task, my CIT is going to be based on 30% of your total profit, which is 30% of this. I will test for minimum tax. Minimum tax for non-life business is going to be based on what? 0.5% of gross premium. My balance of the gross premium after I remove reinsurance premium and this is 650 million. $6.5 million. That is my balance. That is why I use that. My education tax, we are in 2024 year of assessment, 3% of adjusted profit or accessible profit. Since my CIT based on 30% is greater than minimum tax, I will use that. That is the reason why I take this one. Assuming my minimum tax is greater than actual CIT, I will take the minimum tax. I will take it to this side. I will take it to this side. But my CIT based on 30% is greater than the minimum tax. That is the reason why I take 1,274,400. My TET, education tax, 3% of accessible profit. Where is my accessible profit? 4,293,000. Why my police development levy? 0.5% of accessible profit, which is 214. That is my tax liability. The second part of this question said, what are the conditions where a company will pay minimum tax? There are 3 conditions where company can pay minimum tax. Number 1 condition is when the company has an accessible loss, they made a loss. If a company made a loss, that does not mean they will not pay tax. They will pay minimum tax. Number 2 condition, when there is no tax payable, the company does not make a loss, but the capital allowance that they have eroded all the profits, resulting to no tax payable. As a result of that, they will pay minimum tax. Number 3 condition, when the tax payable the actual tax of 30% that you compute is less than the minimum tax, in that case, you will pay your tax based on minimum tax. Those are the 3 conditions for paying minimum tax for every company. So this is what we need to know on this question. Any question, any issue, any query, any observation,